could the real problem come in Q1? The rupee is showing that there is a macro issue at hand too. Crude prices elevated. Vinay Jaising, CIO and Head of Equity Advisory at ASK Private Wealth, Johnson right now on the show. And he's sent us some very good talking points as well. But Vinay, good morning. Neeraj here can't not start off by talking about the macro concerns at hand, right? Before the overnight events happened between UAE and Iran, the CEA had already warned of the possibility of the CAD doubling, having issues about the fiscal deficit meeting, and the rupee showing those issues. Is it therefore a risk of till the crude cool off happens, or do you think about it differently?
No, I think you've nailed it. It has to be a risk off till the crude comes down to sub 90 levels. If you look at the crude chart, 113, 114 now, going all the way down, backwardation to about 75, 80 in the next 3 years. This can change very quickly. The problem out here is India, like most of Asian countries, are net short crude, and hence our energy bill keeps on going up. In India, the equation is pretty simple. We net get about 5 million barrels per day of oil. So if oil prices are up to $113 as against an average of 70, add another $6-7 to freight. So you're actually seeing a $50 hike in crude oil compared to what you consumed last year, same time, 50 times 5. $250 million is a daily outflow purely on oil. Add another $30-40 million coming in from gas, because gas prices also have hiked by almost 70 to 80%. Multiply the two. Last month itself, our bet is the bill for energy went up by as much as $8 billion. So your outflows going up by $8 billion a month. 12 times that, you're losing as much as 80 to 100 billion dollars in a year. So the CAD can be as much as 2% negative to as much as 3% negative, depending on how long oil prices and gas prices are maintained. The net impact of that, and going to your second part, is the rupee dollar. Today, the rupee has been at its highest, weakest level at 95.3 levels. The RER suggests, it's oversold at about 93. But the fact of this is, this entire circular impact puts a lot of pressure on the economy. May not be on the earnings cycle of the company in the shorter term, but the economy, certainly the fiscal deficit, the current account deficit, the balance of payment, all are being questioned. And you will see analysts cut down the GDP estimates a bit if the war keeps on being maintained.
Vinay, very good morning. Tamanna here. I was just going through what you sent us for this conversation today, and I think what really stands out is India's stark underperformance versus other emerging markets, just because, in large part, that there is no AI trade. Do you think even if the war ends in 2 or 3 weeks, as US President Trump has now said in his latest statement, crude comes back and prices come down dramatically, that one part is still going to continue to hurt India's perspective from an FII lens?
So absolutely. If you look at just on a macro basis, whether there are big AI plays as indices, you look at Korea, you look at Taiwan, because of TSMC, because of Samsung, and those countries are direct plays. If you want to play an ETF, it's much easier for you to play if you're a global investor. Having said that, in India, you do not have as much AI plays in the indices. But what will happen is, as FIs start looking into the country, as the dollar, I think, just stops, stabilizes for a couple of weeks and crude goes below 90 for even 4 to 5 days, it is high time, FIs would come into the country, because the FI ownership, at under 16% is virtually at a 15-year low. They would look at India. Though India is a non-AI play, in total perspective, what you do get is there are a lot of capital good companies in the country which provide generators, which provide hot boxes, or I would put it as, ancillaries or picks and shovels for the entire world. You have telecom companies in the country which are tying up with the NVIDIAs or the Googles of the world. So you will see selective AI-based plays coming up in the country, which would gain. And I think FIs, it's just as earnings visibility comes back that, yes, we are not seeing much downgrades, we are seeing upgrades, you would start seeing FIs come into the country. The question is when, and I think the answer to that is rupee stability, crude oil prices going down, all on the back of, the war being behind you.
Vinay, okay, so you've described the situation very well. Alex here, morning. I want to ask you from the perspective of an Indian investor that largely invests in India, and assume that this investor has listened to a large number of money managers and is almost completely deployed. His situation or her situation looks significantly better at the start of May than it did at the start of April because you've had a broad-based bounce back. But now you're saying that there is a risk of sentiment that you have to account for till crude cools off. How do you suggest that they action this? Because they've deployed, they've benefited from staying deployed because you've had a bounce back. Do they restructure, take money off the table selectively? Where do they hide?
Right. I think it's a very good question, Alex. Thanks for that. Last month, Indian equity which came into the DIS was a high $15.5 billion. The number now is a third of that. So you've seen them get some profit, but that's the incremental customer. Also, last month was good for the market, small more than mid, more than large, in that order. You will have stocks in your portfolio which would have gone way above their 5-year averages, which have moved up by as much as 50-60% last month. It may be a wise idea to look at them if valuations are not going your way, to do some profit booking and keep some amount of that as cash on hand, or look at those defensive bets which are also dollar bets. Remember, the entire supply chain problem can come up if the war maintains for the next 3 months. So they got to work on understanding, is there a supply chain issue in companies which they are buying? If the answer is yes, they may want to shave off some money of it, keep some cash on hand, and then get back maybe into the same stocks in the months to come. Domestic story is doing relatively well. The GST numbers have been coming more or less in the right place, though our direct taxes were a little lower in the last month. The forex reserves are healthy. So if you add these two, I think India, if you had to look at a 2-year forward perspective with FIs literally even this month having taken out $6.5 billion out of the country, are bound to come in, and they would start getting into those names which may not be in the indices, but which are giving you growth, assuming a crude oil price regime of $85-90. And that's what even the retail customer has to do. Look at those names which are resilient on earnings, considering an $85-90 oil price. Those names where you're depending a lot more on domestics, it may be pharmaceuticals, it may be the private banks, those sectors which are less hurt by the war is where you would want to, at least in the shorter term, stick around. The capex story in India looks robust, especially those which are exporting to the rest of the world. Focus on those names a lot more, Alex.
Vinay, I wonder if energy becomes a focal central point of a portfolio, considering it becomes a multi-year theme now. If you want to do data centers, if you want to do AI, if you want to do everything else, including basic GDP productivity, India is an energy deficit country. The plans are robust. Everybody's talking about that too. Is that a good space, or is it currently overvalued? And I mean both green energy as well as conventional energy.
Right. So I'm taking cue from the last part of the statement. Green energy is a lot more interesting to focus on, because remember, that's where China has an edge over US when it comes to the pricing of what they give to the data centers. Energy infrastructure players. So when you look at energy, what is the generator which goes into making the energy? What is the hot box you use to keep high temperature products into the picture? What are the airfoils you use? So there is an entire ecosystem which comes below the energy space where we are very excited for. Mind you, here the market is not just India data centers. There are also global data centers which buy from India. And and that's where you're seeing the order books of lots of these companies swell up. Same thing, on the data centers, you look at optic fibers, which are doing a lot more better, which were called commodities earlier. The demand is increasing substantially out there. So you have that space of energy ancillary companies which you would focus on and buy. May not be the pure energy companies as well. On the pure energy conventional companies, it could be one-offs where you think valuations your way, and more importantly, they're growing substantially on the top line. I wouldn't look at companies, where the growth is 5 to 10%. I would look at companies which are really aggressively growing, even in the conventional energy part or renewable energy part, where the volume growth, they have a 5-year capex plan for doubling. I would look at those names. That's where I would look at. Valuations, obviously, keep in mind, have to be very attractive as well.
Vinay, can I ask you a follow-up here? Because I know you look at these healthcare chemical space very, very closely. A thought that is emanated in the last 24 to 48 hours, at least I came across it that way, is that with the Chinese yuan appreciating vis-a-vis the Indian rupee, logistic costs having doubled, so on and so forth, Indian chemicals might actually emerge as a dark horse because that sector has done nothing for the last 5 years. Is that a valid argument, or is there too much that needs to be done for that argument to hold center stage?
So, very interesting question. The Indian currency has been one of the worst currencies, not just versus China, but versus most of the other currencies in the world. There's 11-12% depreciation. That makes India a good hub to get any manufacturing product to be sold to the rest of the world. So that's the starting point, be it in manufacturing or be it in chemicals. Now, when you look at chemicals, you've got to break up chemicals into two parts. And, our analyst Sudarshan is really good at it. Specialty chemicals is the part where you need to focus on, where India has an edge. Now, the specialty chemicals may be used in pure agro, or may be used in chemical industries, or may be used in the pharmaceutical industry. I think where India has an edge is where it goes to the pharmaceutical industry. It may be the fluorine chain, maybe the bromine chain, which goes into making additives, or maybe going into electrolysis. So that's the space we are focusing on to see if we want to buy names, which have corrected, or which are lower than their 5-year averages. But it's a hunting ground. It's not very easy because the names you like, the market, at least in the last month, is pricing it very, very quickly.
Are you at all worried about, and since you've highlighted all of these macro headwinds, are you worried at all about an asset quality issue for small borrowers? Because that's not something that you saw for a lot of financial companies that have so far reported numbers. But I guess that will pan out in Q1, maybe, that you will perhaps have to look at the special mention accounts for some of these banks, particularly those that are external facing, right?
You're saying it really well, Alex. So think of it this way, right? Jan, Feb, March, the first quarter of the year had probably 20 to 25 days of the war, and you had inventory, which meant that even if you had 1 month's inventory, the impact of the war would not come in the first quarter, it would come in the second quarter. So that's point one. Apart from obviously those restaurants in the last month, who could probably not sell anything if they worked on non-electrical induction cooking equipment. But apart from that, or even airlines, which would have had a tough time in the last month. So the impact of the war would only be analyzed, or you would get to get numbers in the next 1 to 3 months. The current quarter's numbers will be better than expected because people would have assumed there's some impact. The pain points really come into those MSMEs where, just assume, you were not getting gas. Oil has now gone back virtually to 100%, just at a higher price for India. So no one's complaining that crude oil is not available in the country instead of coming in from, let's say, it never came from Iran, but some parts of Middle East, it's coming a lot more from Russia now, a lot more from US now. So oil problem is got sorted, but gas still, in our numbers, our analyst tells us, is about 20-25% below what India needs to consume. So those gas consumers, are they shifting to coal? Are they shifting to oil? Is it that easy? Will their earnings be a question mark? Will that come into the banking picture? It may not impact the economy, but you'll have many one-off cases, and you would have to look at those MSMEs, and in the same way, those banks which have exposure to those MSMEs and partly avoided. I think the good way to look at it is if the war to get over in a week or two, as you discussed in the start, you may just see a tepid this quarter, which is the first fiscal quarter of F27, and things will get a lot more better in the months to come. Or else you would start seeing the questions you're making, and you may start seeing earnings downgrade, but more importantly, question marks on the quality of the MSME's receivables.
You know, that you've put it really well, Vinay. That is the suspense, right? Can companies hold out long enough, or will the West Asia crisis resolve itself in time? So it's a game of survival really right now. Thank you so much, Vinay Jaising, for joining us. Always a pleasure to have you on and speak with us. But we're also looking close.